All right, I think we're live, everybody. Hey, welcome to my first ever live stream broadcast, and it is really exciting. If you have a drink, hold it up, give us a cheer, and if I screw things up really bad, try not to hold it against me. But, I have two professionals here with me tonight that need no introduction. We have Mr. Ryne Williams from Las Vegas and Mr. Rusty Ram 78, otherwise known as Russ Knopf from, I think you're Chicago, right? Or at least Northern Illinois area.
I'm Chicago suburbs.
Chicago suburbs. That's
Uh-huh.
awesome. Well, thanks. I really appreciate you guys joining me for this. I think it's going to be a really fun program because the subject today is what would I have wanted to know if I were to go back to being a beginning investor, what would I want to know then that I do know now? And so I think that's going to be a fun content. But first of all, let's take a look at some of the folks who are on. And I've asked where they're from. So we have Pat Schuster is on. So that's awesome. Welcome, Pat. And Pat's from Michigan, looks like. Now, we have Taylor Bernard on the broadcast. I don't know if I know Taylor, but Northeast Ohio is where I lived for about 21 years. So welcome to the broadcast from Northeast Ohio. It's awesome that you're on. And looks like I've got Jim Betts from Lincoln, Nebraska. Shamir from Canada, and Shamir loves those Canadian banks, right? So he's from Canada. Fast Eddie's from Fort Worth. Welcome to the program. We have Rui from Lisbon is in the house. That is so awesome, man. Glad you're here.
What time is it in Lisbon?
It's probably late or early. It's probably really early.
I think it's like 2 a.m. I remember Rui telling me he was watching this at 2 a.m. one time.
Wow.
Yeah.
Oh. Yeah, that's pretty early. Then we have SCHD Stan, also known as Leroy Skywalker. Looking forward to it. Where are you from, SCHD Stan? And we have New York State, Carmagna. That's interesting. And again, I'm kind of new at this, so we're going to stumble through a few more of these, and then I'm going to let my guests introduce themselves. So we have Puerto Rico, Ray Lopez is from Puerto Rico. Mariana is from Massachusetts. We got Chris, and I'm not sure where he's from, but Billy Johnson is on from the Philippines. Welcome, Billy. I appreciate all of your comments on my videos. And then Russ says the whole world is here. I think, she lives in Canton, or he lives in Canton. So I lived in Hudson for a while, so welcome to the show. It's really, really good to have you from Northeast Ohio. So I'm going to look through. And Totomi says, I'm glad you're doing your first live show, Kevin, and I appreciate that. I'm a little bit nervous tonight, so I'll try to kind of hold it down. When I get a little nervous, I start talking fast and making no sense. So if I do that, these guys will jump in and kind of calm me down a little bit. And
hey, we're live. We're live without a net, buddy. No pressure. No pressure.
There is no net here, brother. So anyway, my guests need no introduction, but I think we're going to introduce them anyway. So we have Ryne Williams. Ryne, if you want to tell folks who you are.
Yeah, so like all of you guys, I am a diehard dividend investor, hailing from Las Vegas, Nevada, aka Sin City. How about that right in? And yeah, I have a channel here on YouTube where I talk about dividend stocks and share what moves I'm making, what dividends I'm getting, and I'm having a whole lot of fun doing it. So that's what I got going on.
And then my friend Russ.
Russ, Dapper Dividends from Chicago. Got a dividend investing channel. And I'm happy to be here, Kevin. Love talking to all you beautiful people out there in the world and staying up past your bedtimes for us. Looking at you, Lisbon.
Yeah, we're getting up early. Yeah.
Or that.
And I have links to their channels in the notes to this program. So if you want to go to their channel, please do so. But I'm guessing most of you are probably already on their channel. But anyway,
proceed with caution.
That's right. So, it's really exciting to be on this first live broadcast. And I thought it was really cool once I thought about who was going to be on the program to think about the split that we have of people here, because we have Ryne Williams, who, might I say, is in the first half of his career toward dividend investing, right? And then in terms of age, right? So Ryne is the youngest one on the program, so he's like in the first half of his journey, and we have Russ, who's in the middle part of the journey, and we have me, who is in the last half of the journey. I won't say which half or which part of that last half I'm in, but I'm in the last half of that journey. So I think today we're going to get some really interesting answers to these questions. And wow, Code says, hello, handsome investors. I don't know if I've ever been called handsome before, but I really do appreciate that. So with that, the question today is things we wish we had known. And so I want to kind of throw that out. I don't know which one of you guys want to start first, but
It just made me feel like that made me feel like I was on Jeopardy, man. Like you're Alex Trebek over there. The late, great Alex Trebek, might I add. From Canada, he was.
Russ, why don't you kick it off, man?
Yeah, for sure. So probably one of the main things I wish that I knew or I would have done differently is to hold on to those great companies and not sell them when you think they're overvalued. There's so many companies. One of them that comes to mind is when I first started doing this. It was United Health, and I believe it was right around $200 a share that I owned. This was pre-pandemic. That I owned 10 shares. It wasn't anything world, breaking. That's not the right word, terminology, phraseology.
Groundbreaking.
But groundbreaking. It wasn't anything groundbreaking. But the point being is that I believe I should have looked this, over 300 a share now, or at least in that vicinity. And if I would have just held them, I know there's been so many people, I don't know if you guys are also in the same boat with me, of holding something that's a great company and thinking like, yeah, this looks like it's a little overvalued. I better lock in those gains. And that was a bad thing. So that's definitely one thing I wish I knew, is to just buy those solid companies and hold on to them for dear life, unless your thesis for investing in them changes, and not just because they're overvalued. And I'll end it with saying that PepsiCo is the one that I have I have that call option out there. Won't get into that, but I still own the shares right now. But the point being is that when I was doing that share a week, for those of you watching that don't know, I bought a share of PepsiCo every week for 100 weeks. And I remember buying at $140 a share and thinking like, this thing is way overvalued. I would never be buying here if it wasn't for this silly little challenge thing I'm doing. But I'm going to do it anyway. And then, as you just saw a couple weeks ago, we were pushing $200 a share. So great companies are going to be great companies, and they will always be in demand. That's one of my many takeaways and things I wish I knew. So hand it over back to you guys.
Okay, Ryan, it's your turn.
Yeah, I mean, there's so many things I wish I knew before I got started or as I was getting started, but one thing that comes to mind is not to assume that a dividend king or a company with an extensive dividend growth history is always going to be a safe, risk-free investment. It's nice to see companies with dividend growth histories that long, but a couple examples come to mind of ones that ended up having a lot of risk, and I wouldn't have realized that at first, like 3M, VFC. 3M still has their dividend intact. VFC cut theirs, but VFC was a dividend king prior to. But I remember when I first got into this, I would look at those sort of companies and just assume that because they had long dividend growth histories, that was kind of the end-all be-all for me. And I ended up pulling the trigger on a handful of those companies just for that one reason. And I didn't really understand that that's just one piece to a much bigger puzzle, if that makes sense. And knowing that from the get-go would have really helped me. And I think a lot of newer investors, or at least in my case, gravitate towards a metric like that and put a lot of weight on it at first because it's a really easy one to identify. It's a really easy thing to look at and say, 3M's been growing this for 65 years or 66 years. What could go wrong? But a lot of things could go wrong, and now we're kind of seeing that play out.
Mhm. Yeah, that's a good point. Absolutely.
I want to say something to that, Ryan. I would build on that and say I also guess I would have told myself, or I wish I knew that it's because I did exactly what you said, and that was one of my notes is buying something just because of its dividend growth history, is to focus more on the next 10 years than the last 10 minutes. Like it can be useful to know where a company's kind of at right now, but where they're going is ultimately going to be the most important thing. And that's also the hardest thing to determine. So love that. Love that one.
Yeah, that's exactly right. I mean, if you think about it, what you're buying when you buy a stock is you're buying the future. You're not buying the past. But unfortunately, the past is a lot of what we have to determine where the future's going. And so it's that weird dichotomy of, having that information, but not being able to really rely on it when we're trying to figure out what the value is. So, yeah, that's a great point. So, then what do you do, right? And I think you kind of look at what's going on. You look at their strategy, you look at the management team, and make the best decision you can make, right?
And I think having said that, you have to start somewhere, right? If that's the first thing you're looking at or the only thing you know, then at least that's something. You can kind of build on it from there, and we all kind of have to pay our dues in a sense, and we maybe lose some money in the process, but as we say, that's the tuition. But I will say, kind of building on that a little more, and this could be another thing that I wish I would have known. I really wish I had at least some basic understanding of financial statements when I got into this stuff. At least if I was going to be buying individual companies, which was where I was. So if there's any brand new investors out there, if you're looking for the best place to start to do better research into companies, that would be it, is to try and familiarize yourself with the income statements. It doesn't have to be anything crazy at first, but learn what revenue is, learn what earnings per share is, learn kind of how to look at a balance sheet, understand that free cash flow is huge when it comes to these dividend paying companies. I didn't know any of that stuff when I started, and it makes a big difference, obviously.
Yeah, one thing that impresses me about you two guys is that you are always reading something and always learning something and making, whether it's about content for YouTube or whether it's about investing, you guys are always moving the needle, moving the bar, and it's really fun to watch. It's inspiring actually to watch. So, I couldn't ask for two better people to be on my first live broadcast. So I
Thanks,
appreciate
Damon.
you guys being here.
I'm honored to be doing this. I'm honored to be doing this with you because I really do. I'm not trying to toot your horn too much, but I really do learn so much from watching your videos, and you do just a great job. So I'm really happy that you started doing this.
Agreed.
Much appreciated. So how about if I take my turn now? And, I've been down a long road here, right? And so one of the things that for me was really helpful. And if you think about, anything that we do in life, right? Like in sports or whatever, you're always putting yourself against somebody else, right? Or one team against another. Or so if you're playing tennis, you have an opponent, right? And so you're trying to overcome that opponent. And the thing that I wish I had known when I first started is that the opponent in this game is not another investor, and it's not the market. It is me. And so I got a slide here. I'll put it up, I think, if I know how to. Here's how you do it. No, it's not. There we go. How about that? Can you see that?
Mm-hmm.
Okay, so Benjamin Graham said the investor's chief problem and even his worst enemy is likely to be himself. And so why is that, right? I'm going to take this thing off the screen so you can see it. There are pitfalls really, related to just being human. And some of those, I don't want to get too far into these, but I just want to give an idea of what I'm talking about here. And so like the second one here is panic buying. So there's a fear of missing out a lot of times when it comes to, buying stocks. And so as we come across these tendencies that we as humans have, we're really fighting against ourselves, and we're doing things in the stock market because of fears that we have, like this regret theory. is that we fear regretting a current decision sometime in the future, right? So we're hesitant to make a decision because we're afraid of what that future holds. And so there's several here, and I won't go through them all. You can, go back and watch the video and stop it right here if you want. But those are kind of the things for me. And again, I'm trying to figure out how to get this off the screen. So how about that? No, how about that? That's much better. So for me, what I wish I had known then is that the enemy is really my own emotions. And so, trying to decide when to hold onto a stock and when to sell a stock, all of that is emotional, right? And so it's really me that I have to get to know. I have to get to know myself. I have to get to know what my fears are and whether they're rational fears or irrational fears, and make decisions based off of understanding myself better. So,
dude, going with Benjamin Graham, you also remind me too. One thing I wish I knew just popped in my mind was that Mr. Market is irrational, and you don't have to do anything. You can always wait for a better price. Like Buffett always says, you just stand at the plate. You don't get called out. Just wait until you get that big fat pitch that you like and knock it out of the park. But you just don't know when it's going to come. But you do not have to take swings if you don't want to. So if you don't like the price today, Mr. Market will come back with a different price tomorrow.
Yes, he will. Absolutely. So we've got some questions here. You guys ready for some questions? We're going to shift this over into Q&A. Maybe who knows where this is going to go, right? We could go anywhere from here. And hopefully wild. It's uphill, not downhill. Okay, so I've got some comments here that are starred. And one of them, Kevin Ryberg, asked if he should, is Bush allowed here, or does he need to reach to the St. Pauli girl? And I think Russ has already responded to him, and so the St. Pauli girl is in the freezer on ice. So
treat yourself right, Kevin. Go with the girl.
Absolutely. So here's something from Code Monkey, and the question is, as dividend investors, how often do you use technical chart analysis to determine when they are overvalued or even undervalued, I guess? Or do you strictly use fundamentals, which he's in his conference calls, earnings reports, etc.? So what would you guys say about that?
I would say technical analysis shows you nothing about the value of a company. It's just showing you price movement. That's all. It's just showing you momentum on the prices. There is literally, you're not going to get anything if something is overvalued or undervalued for that. You need to do the discounted cash flow, try to determine it. And it's a lot of guesswork in and of itself that way, to look at what a company is going to produce in the future and then discount that back till today. But as far as technical analysis, man, I mean, you could turn the chart upside down and you might get the same result. I've probably had about a 50-50 success rate guessing where something's going. But like I said, I was telling them in the chat with that PepsiCo covered call, dude, before their earnings, I said, okay, even if they crush earnings, I see resistance at 187.50, but I doubt it'll really break 190. And there we were at 196, a few weeks later. And now it's starting to pull back because you could just tell on the chart that price is moving up too far too quick or down too far too quick. And there's kind of that reversion of the mean, that momentum, that it will go back the other direction. We just don't know how far it will go back and when. So it's, I think it's a lot of like astrology. It's a lot of people that like to use the charts to make videos and predict like they know what's going to happen. But ultimately, the stock price is going to follow earnings, and the chart is not going to tell you anything about earnings 2 quarters or 2 years from now. So I'd say use charting with caution, but it's not going to tell you anything about the value of a company. It's my opinion.
Ryan, what about you?
Yeah, I don't know what else I can add to that. That was perfect, Russ. But I've spent 0 minutes on technical analysis, not technical analysis. That might change in the future, but I don't know. For all the reasons Russ said, I just haven't seen a need to do it. It seems like maybe it would just make more sense if I was trading, but that's not really my cup of tea. So it's just not something I feel that I have a need to do.
Yeah, that's great. I mean, that's what my answer is as well. But I will say this, and I'm with Ryan on this. I don't know a ton about technical analysis. I know a lot about businesses and I know a lot about financial statements, but I don't know a lot about technical analysis. So I think from my perspective, and here's an interesting story. Maybe you guys will find it interesting, maybe not. There's a guy I knew from Northeast Ohio, Taylor, and he connected with me through email the other day after watching these videos that I put out there. And he was like, hey, I've been learning about this technical analysis. And he showed me some examples. And so what my first thought was, I don't know much about it, so it really can't have much value. But then I got to thinking, I don't know everything either, right? So what I'm going to do is I'm going to respond to his email and ask him to give me two things. One is Whirlpool and one is Stanley Black & Decker. Right. Mm-hmm. Those are two of the biggest mistakes I've made in the last year and a half is getting in. Not that they're mistakes from a business perspective, but that I got in too early and I got in, as they were falling. So, and I still have them, but, so what I want to do is find out if the technical analysis that he's talking about would have predicted for me a better time to enter into those stocks at those given times. And I'll let you guys know how that comes out, because that's a way to kind of test this, right? Is to say, let's do a back trace on it and see how I would have changed my investing in Stanley Black & Decker and Whirlpool. Very real examples for me. So I think the jury's still out is the way I would propose it. And so I'll let you know how that goes. So,
I would add one more thing on that is that you can try to use the chart to see if there's a better entry point, or if you're getting in something like you said, you might be able to get into it a little bit cheaper. But I've seen too many times where I was wrong. Starbucks is one of those. When I was selling covered calls on that, I didn't expect it to go up where it went to. And it just, unfortunately, it was wrong, and I think if you are trading short term, if you're like doing day trading or, swing trading, like by week, the chart can probably be very useful. And I know there's a whole crew that does not even crack open an annual report. They don't care about the fundamentals, anything like that. So, but if you're a value investor, then your tools of the trade are going to be the annual report, the fundamentals, the financials of the company, seeing where it's going. And I just wouldn't even worry about that. If you think a business you want to own is at a fair price, I would say just buy it, because otherwise you can get caught trying to wait for it, because the chart shows it should calm down. And I mean, charting really is, it's an art. It's not a science. So that's, stay away from it. If you're new, that's for traders. Don't even worry about the chart.
Yeah, your time is much better spent learning, once again, how to read financial statements. It's going to help you so much more in this long investing journey, especially if you're going to hold on to companies for the long term, because that's what even though we don't know what the future holds, we can look to the past on the financial statements and at least get a gauge of how well they're managing their capital and the trend that the business is headed in financially. And hopefully the stock price should reflect that.
Yeah, in the long run, right?
In the long run, right.
Yeah, because sometimes we go through these valleys, like I'm going with Whirlpool and Stanley Black & Decker. So,
what's the Graham quote? You guys missed it. Dude, the Graham quote. I was waiting for one of you to hit the famous Benjamin Graham quote. You want to take it on the long term of the market?
Yeah, it's all yours, Russ.
Oh yeah, weighing machine versus voting machine. Is that what you're talking about?
There you go. Yeah.
So in the short term, it's the market's a voting machine, but in the long term, it's a weighing machine, right? That's
it's a popularity contest in the short term. Absolutely.
Yeah, good point.
Yeah.
All right, great question. So we're going to move on now to the next question on the list, which is from John J. John is asking, company financials and metrics are shown in the annual reports, et cetera. However, how do you grade the management team? So I'll take that one first, if you guys don't mind.
You had a really good explanation of this last weekend, Kevin, when we were talking.
Yeah, so two of the pillars that I look at are company strategy and the management team. So the strategy piece of it, I look at, where they're heading, how they articulate the strategy. Is that strategy something that's going to win in the long term? Obviously, there's a lot of judgment in that, but I look at their strategy. And then the next thing I look at is whether that management team has the capability, in my opinion, of being able to carry out that strategy. And a lot of what I look at, just to be more practical with that, John, is that I look for things that really a couple of things. I look for mergers and acquisitions, and I look to see if those mergers and acquisitions tie into that strategy, if they are really moving their strategy forward by the capital that they're expending from the company. So that's really one way. And the other way, and this is not always available, but it is really telling, and that is look for a time of crisis in the company. Something has gone wrong in the company. Just because something has gone wrong doesn't mean the management team is bad. What you want to look for is how they handled that issue. So if they handled it with clarity, if they handled it with transparency, if they dealt with it in a very real and expeditious manner, then that's what you're looking to see. You want to see who they are, right? A crisis doesn't define you. How you handle the crisis defines you. And that's what I look for in the management team, is how do they handle themselves when, things are not going as well. So I don't know. You guys got anything in addition to that?
Yeah, I think I like to listen to the earnings calls. I love to listen to the CEO and pretty much the CEO and CFO, right? Those are kind of two of the more main players in the company. And I just love to hear if they have that passion, if they sound robotic. You know who I get that from? John Stankey from AT&T. I just get like, okay, this is what I got to say, and it's just robotic. But when I listen to, and you guys are I know I've been saying it a lot. I've been on Harrow Health, Mark Baum, the CEO. That dude, that's his baby. He's the founder and CEO, and he has a passion and a mission to provide low cost eye treatment, low cost pharmaceuticals to everybody. And he wants to make a win-win for the company, the shareholders, and the patients. It's just, I think that's something to me that's important, is if the founder, or not the founder, if the CEO thinks like an owner or like a shareholder. And to me, that's something that's pretty important.
Kind of on that note, one thing I was going to ask you guys about is what are your thoughts on share-based compensation? Is that something you like to see?
Yeah, I don't look at it a lot. I know that there's some folks who look at it, and it really sways their decision on whether to buy a company or not. I don't really even look at it, to be honest with you, because
I think
if they're bringing the results, then why do I care whether they get paid in cash or in shares? So
yeah,
that's the way I look at it.
I don't remember. I think Warren Buffett, and you talk about books. I love this book, dude, the Essays of Warren Buffett. I think in here he said it's either 2% or 1% a year is what he wants to see it at or under for compensation with shares. But yeah, if it's egregious like 10%, then that's actually harming the shareholder, right? Because that's going to be diluting everybody. I mean, unless they're growing the company at a rocket ship pace, then it's but it's not a huge thing, but it's something to pay attention to, I guess.
And the reason I asked was because maybe the thought is if they were paid in shares, they might be more incentivized to be more shareholder friendly since they are one. But maybe that's not something to read too much into after all.
Well, they can sell them. They can just sell those
Yeah.
on the market, and the restricted RSUs, the restricted stock units. But
Yeah, I think there's a lot more info that we need there, right? Because if the
Yeah.
shares are very short term at their, let's say a 3-year period, and they get the shares dumped out to them and they can sell them all immediately, then they're probably going to be more weighted toward making decisions in the short run that may have long-term impact on the company. So
That's a good point.
Yeah. It's my perspective anyway.
Sorry guys, I got the glare coming in right now.
Okay. I thought that was me. Okay, so let's go to Tommy is asking, what is my favorite stock that I own? And I don't know that I have a favorite, but I think right now my favorite is Johnson and Johnson. And the reason I think that is because I think that with this split off with Kenview. I think there's going to be a lot of value there. It's really weird for me because I'm always thinking of companies merging and creating value. But I think in this case, having the company split is going to provide value because you're going to have really a growth in an income stock basically at the end of the day. So I'm looking forward to that. And I think because of the anticipation of the future, it's my favorite stock right now. So what do you guys think? Yes, for Kevin, but I'm going to throw it out to Ryan.
Let's see. I mean, I would say Starbucks is probably one of my favorites just because it's number one, it's done really well for me. I think it's a really solid company. It's also one that I feel like I know really well because I've been just a pretty adamant customer of theirs for a long time. And so I'm really excited to be a shareholder and an owner of the business as well. But another one that I don't know if this is my favorite, but another one that I am really excited about, and I know I talk about it all the time, but I'm really excited about Kilroy Realty Corporation, only because I every time I look at it, I just see such a mismatch in price compared to the company's fundamentals, and that excites me, thinking maybe I have something here that's kind of a contrarian thing that nobody wants, but is going to end up being a good investment. But time will tell on that one.
Yeah, Russ.
Yeah, for me, it's kind of like asking which is your favorite kid, right? uh, but J and J is an easy answer, and I'm looking at them actually coming now into the 150s, and yeah, I kind of missed. I thought they were going to hit 140, and that was before the settlement and all that. But I might just start adding them a little bit more. And PepsiCo, I just still like them. I like what they're doing. I think they just have such a gigantic moat. When I go to work, it's insane. Every day there's people drinking. I see Mountain Dew and Lay's, Doritos, just all the products they own for some reason. It's just they're so ubiquitous, at least throughout the American diet, that I just think they're not going anywhere anytime soon. Their free cash flow is a bit of a concern, but I emailed the company because I voiced my concern, and they said, well, no, we're investing in the future. And, in so many ways, they said it's just because of the investments we're making for tomorrow, and it's going to start paying off. But that's the rub, right, is that it's going to. So I'm keeping a close eye on their free cash flow and to make sure that that's going to start coming back down. But yeah, I really enjoy PepsiCo. And if they would ever come back to the 160s or 150s, I would like to start buying more. But I'm content right now with them. And then, yeah, I have a few others that I'm looking at, but yeah, I guess I'd say J&J is probably got to be up there, and PepsiCo are the top two.
Awesome. So here's we have Zal Doth in the house, and he says great content from all of you guys, and that Drip and Sip community has been an amazing influence on my continued growth as an investor for these past 2 years. And I put this up here because I just want to say, Ryan, you have done a great job with that Discord. And I'm not sure if I can add it to I think I can add it after this, but I should add a link to your Discord. And so anybody from that's watching this even afterwards can go over there and become part of that Discord. It is really a phenomenal community, and it's really cool because Zal Doth is one of the contributors in that community, and it's only as good as the people who are in there. And it's just a bunch of people who are giving their best opinions and who are working together for the common cause. So great point, Zal. So
I need to ask a question about it because I don't think I've ever been on the Discord, and I always hear about it, Ryne. I just had a brain fart. You see what happens when you're live without a net? I think I was going to ask something about is it good content? Like, is it very time consuming? Is it more like, so put it this way, on Twitter, when I'm on Twitter, it kind of gets old because it's just a lot of, I don't know what to call it, but just bland, broad statements, and
No,
things people say.
That's not what's going on in the Discord.
I didn't think so, but it's just information, right? Like
it's
sharing ideas.
It's just like we're talking now, very in-depth conversations, just in text form. But I was going to say, Russ, before I was going to say, dude, I think you'd really enjoy being in there. I'm not trying to pressure you to join, But I
But he
think,
is.
yeah, I mean, no, but I think you'd really, sorry guys, I know that's whatever, but I think you'd really enjoy being in the Discord group. I think it's a place that you would end up spending a lot of time at, just because there's such great conversation, and there's a lot of great contributors like Zal. Kevin's very active in there as well. Jacob Morris, we got Turtle, we got Mr. Income. Pat, I've seen Pat interacting in there more. I've seen Shamir in there more. Mountain High, who's not here. There's just a lot of great people in there, but and I've learned a lot, just even if I don't always engage or message in there, just reading through the conversations, there's a lot of really good things to learn.
I think I'll stop by because I'm kind of becoming, I don't know if jaded is the right word with Twitter, but it's just like for the amount of time I spend, I really don't learn a lot. It's usually just a lot of fluff and dividend porn, just everybody showing, what dividends they're getting. And I don't know. I just don't get as much value from it as I probably would from your Discord. So, yeah.
Yeah, and just to kind of reiterate, it's really about the people who are in there, and these folks are not afraid to have a dissenting opinion, right?
Yeah.
And so there's a lot of good discussion that happens because people don't necessarily agree on a particular topic. So it's really it's good content.
And it's
I
not
gotta say
hostile
something.
either. It's very respectful too. Like
Good.
There's pretty much no moderation necessary because everyone's acting in good faith all the time. It's great.
I just saw Troll Huntress's comment about too much sugar in PepsiCo. That's actually not true because it's trending away, kind of like how people are cutting out smoking. Ramon LaGuardia has repeatedly said in the earnings calls that non-sugar is king. Everybody wants non-sugar. They got the Pepsi Zero Sugar. They've got Gatorade Zero Sugar. You might not like some of the sugar-free chemicals that they have to use. I know my family has some questions about the aspartame and some of that, but anyway, it's approved by the government. They can use it. So they are moving toward meeting that customer demand. I know I sound like a representative from the company now, but they get it. And, I will say this, just sorry to talk over you guys, that this is what I love about investing is that the market is constantly shifting and changing. Consumer demand is shifting and changing. And these companies are living, breathing entities, and they are doing what they have to do to survive. And they're going to adapt. They're going to try new things. They're going to buy, if you're Ultra, you're going to buy Juul and get bid on that and then buy Enjoy because you want to get into the vaping market. And I just think it's so cool to watch these companies in real time as we're alive, watch them evolve and adapt. So there is sugar, but they hear the consumer loud and clear, and they're starting to move more toward non-sugar.
Yeah, that's good. Thanks for that.
That was a rant, but hey,
Okay, next one on the list here is what are you guys planning to buy if it hasn't been answered yet? So maybe we'll start with Ryan. Oh no, let's start with Russ. He's representing there.
That's you. I was gonna say this. I'm the guy though drinking tea out of a Hershey's mug, so take what I say with a grain of salt.
I thought you were gonna say you're gonna buy Hershey.
I would like to, but I remembered from our conversation that's one of the ones you would like to buy is Hershey.
Yeah, absolutely. I love chocolate, so yeah.
So this week I bought Lowe's. I think that's a really great company, and I wouldn't mind. I probably won't buy any more next week because it ran up. But Johnson & Johnson's kind of been catching my eye, kind of like you were talking about. I think it's at a really good price right now, and in my portfolio, I have an opportunity to average down a little bit, and a company like that's always a good idea. Owl Rock Capital Corporation is another one that I've kind of been thinking about adding a little bit more to. It's a business development company, kind of like Main Street Capital and Ares Capital. Just reported really, really great earnings, record-breaking earnings for the company, actually. And so they seem to be firing on all cylinders, and so I wouldn't mind maybe picking up a couple more shares of that, but probably wouldn't put too much more into that company because don't need too much high exposure to high yields. I'm young, so I got time to let that dividend growth do its thing.
Mm-hmm. Russ, what about you?
For me, Nexstar Media. I The more I look into them, the more I think that they're misunderstood, and it's probably going to take until about 2020, early 2024, mid 2024, before people really start realizing that. They've got it. We got the presidential election coming up next year, so in those years, their revenue kicks up, and then they use a lot of that extra money to reinvest into the business and grow. So I think Nexstar Media has a lot of things cooking. Again, one of the companies that you have the CEO who is also the founder, and Perry Sook, and he's just been in the industry for over 30 years. The more I look into the company, the more I like. I'm up to 49 shares of them. Super high cash flow. I think they're really good. And then what I'm going to be looking into, and I'd love to know if I don't think Ryan does, and I don't know if you've ever looked into this, Kevin, because you've been around the block more. But talking with Jeremy from Dividend Stockpile, we talked all about closed-end funds, and it's something I never really understood and I've never really looked at. But it's almost like an ETF that's on steroids that you buy for income and a little bit of capital appreciation. And there's just thousands of closed end funds. So I do have a much deeper understanding of closed end funds, but some of them look really, really interesting. And I was just curious if either of you have ever looked at closed end, or anybody in the chat, closed end funds.
Oh, it looks like Income Factory.
Yes. Have you guys read
Yeah,
this?
yeah, I have.
Russ,
Well, I've listened to it. I should read the physical book next, but
I sent you a voice message on it about an hour ago.
But, I still have to listen to it. Yeah.
No, but I want to go through and reread this. I read it when I first started investing. It was way over my head, but I'd like to, kind of revisit it and see what I can pick up, because it does seem like a really interesting book and a really interesting way to invest. And if nothing else, I think one of the important takeaways from reading something like that is it helps you understand total return, I think, and how a high yield can still result, high yield, low capital appreciation can still result in a solid total return. I think oftentimes that kind of gets overlooked. Or high yield investments get a bad rap, but there's some pretty solid ones out there that can still deliver pretty solid returns. So there might be something to it.
Yeah, and that book is actually on my list to read. I think it was PPC Ian who did a book report on it, and it was I thought it sounded really intriguing. So I'm gonna get that and read it here very soon. So.
It's the reason why I started investing into Main Street Capital and Ares Capital is the whole reason. And I had shunned them and I didn't want to look at them. But again, Ian had that awesome interview with Greg, the Dividend Monster, and he turned me onto that book. I read the book, and it really, sometimes things, because we don't understand them, we don't fully understand them, and we're making a decision and a judgment. So I thought, you know what? I remember hearing BDCs, stay away. Closed-end funds, stay away. They're higher yields, higher the risk. Don't even bother. But then I realized when I heard Greg talk, I was like, you know what? I've never really tried to understand these and then say, no, I don't want to buy them because I have a deeper understanding of them instead of just somebody else telling me. And I think that's kind of a smart thing, don't you? Look at try to understand why something's a bad investment, and then, kind of invert, right? What does Buffett and Munger say? Invert, always invert. Start with what is bad, what could go wrong, and then work backwards from that instead of automatically reaching for what's right or good about something.
Yeah, I think that's a great point. And I think maybe the moral of that story is that, we should always be learning, right? Not just, forming an opinion, but learning, and then letting the opinion be formed by our learning as opposed to just our emotions. So, yeah.
That's kind of, this is kind of one thing I struggle with is finding a balance between kind of what you were saying, Russ, being okay with more of those high yielders, and also knowing that I'm still young with a lot of time on my side and emphasizing more growth. I'm trying to find a balance between the two because I like having both in my portfolio, but for me, it's been a tough balance to get right. And I'm not quite sure, where exactly I want to be in that spectrum, if that makes sense.
Yeah. Yep.
Okay, next question. We kind of got diverted there. Oh, actually, I didn't give my my what I'm planning to buy. Right. So my 3 for the month of May are Johnson and Johnson, Cummins, and Cummins is going to need to come down a little bit more for me to get in because it's still pretty far above my cost basis, but it's, I believe, in territory for being undervalued. So I want to add more to my Cummins position, but it's going to have to come down a bit. And then the other one is Raymond James Financial. I've done some research on that, and I really like the management team and their focus on the long term. So, those are the 3 that I'm looking at for the month of May. Okay, guys, Rui has gone off to bed, so all the way from Lisbon. So thanks for stopping by, Rui. And then Ryan, this is for you. We're all going to chip in and get you a shade for that window. So well done.
So I have my blinds right here. Obviously, I put a cardboard box up there to see if it would block the light, and all I had to do was scoot it over a little bit to the right, and the problem solved. So
well done.
We're good.
Well done. Yeah. So then Sassy here is asking about when J&J is going to split. I did a video on that, I don't know, a couple of weeks ago. Looks like it's going to be around the October-November timeframe, and I think some people have answered that in the chat. So
I think it's going to be right before Halloween because that would be 6 months from when they did the IPO, right? So the lockup would end. And if I understand it right, all of us inside of that are J&J shareholders are essentially kind of like the insiders having pre-owned before it went public. So I think that's why they're doing it this way and to make it tax-free, right? That they're going to spin them off 6 months after.
Do you guys
go ahead.
Have you guys, and Kevin, I think you kind of talked about this a little bit earlier in the video, but do you guys know what you're planning on doing with the Kenvue shares? Do you think you'd hold on to them?
Yeah, from my perspective, I'm going to hold both unless there's still more information that needs to come out in future S1s, and how much debt is going to go to Kenvue and all of that. I think that's pretty well. They've at least told us what they estimate that to be. I just want to make sure that happens, but yeah, I think I'm going to keep both because I think the Johnson & Johnson side with the equipment and the drugs, I think that's going to be their growth company, and then there's going to be more of a stable Procter & Gamble like company that's going to be Kenvue, and so for me it's going to be a good growth and income combination. So I'm planning to keep them both.
Same. Russ, I'm going to keep both. Yeah, absolutely.
Okay, Ryne, where's Peanut? Shamir wants to know.
I talked to him earlier today. He was headed down to the strip to play little craps. I told him it's a bad idea. You lost too much money yesterday, but he said, nope, I'm going to go redeem myself. I've got a bone to pick. So.
Okay, here's something for both of you guys. I'm supposed to ask you guys about the 20/2% stocks you won and what should get rid of.
22. I know about the 22 rule that fund advisors charge, the 20 and 2%, but I don't know what my 20/2 is.
Yeah.
You get a little more. Do you know, Ryan?
No, I don't know.
I'm not sure.
I love it, Fast Eddie. That's news to me. You threw us for a loop.
Awesome. So
now I need to know. He created a loop in my mind. I'm like, what's my 20/2 stock?
Yeah. So Fast Eddie, if you can kind of clarify that, we'll pull that back up here. Sassy here says that they bought some more Vici. Yeah. So well done.
Ed Petoniak. I really enjoy Ed Petoniak. That's another CEO that I really like. Enjoy listening to his earnings calls. The direction they're taking Vici, it's why I bought more Vici too, because they bought a casino in Canada, or they partnered with a casino in Canada. I don't remember if they funded it or they bought it outright, but they want to expand into, they've funded, I think, Great Wolf Water Parks or Great Wolf Lodge, something like that. I know I should know all this information, but they want to expand into more experiential, like water parks, family resort type places. So Vici, they got plans to start really growing past the gaming properties. So I think they're as stadiums. They even said like youth, college, and professional things to do with that. It's really interesting. I think they've got really big plans. So I think Vici is a company to watch for the next decade. And it sounds like I talked myself into buying some more this week. Good job.
Yeah, well done. So let me go back over to here. Managing this is a little more complicated than I thought because there's a lot of comments that are coming through. So here we go. This is one from Kevin, and Kevin is asking, thinking of adding a third to his consumer discretionary portfolio. He can't decide between Home Depot and is that
Dick's? I think
Dick's
that's
Sporting
Dick's.
Goods?
Yeah.
Okay. What do you guys think? Any advice for Kevin?
I mean, if I had to choose between those two, I'd maybe go Home Depot. But I would also, Kevin, I would look at Williams Sonoma. I think that's a really great looking company at a great value. So if you're open to options, I would take a gander at that. I might start a position in that company here pretty soon. I've spent a lot of time with it, and I've been pretty much decided I'm going to buy it. I'm just waiting for their earnings to come out in a couple days to see what happens, and I'm going to go from there. But I think that's one to look at. Dude,
you nailed it with Williams Sonoma. Same here. I love that they have no debt. I mean, that's just awesome. And I think that because of the trend we're seeing with retail, that earnings, they're showing that the consumer has been pulling back on the consumer discretionary items, meaning all your non-essentials. So stuff like home furnishings, electronics, clothing, specialty goods, things like that. The consumer's been tightening up their wallet on those things. So I think that Williams Sonoma is probably going to have a couple quarters of less than stellar earnings. And I'm hoping, kind of like Ryne, that their stock price is going to get knocked down for that. And I really would like to own Williams Sonoma, but I think we've got some better buying opportunities coming. I hope. So it's weird. You usually don't want to root for bad earnings, but I'm kind of hoping for Williams Sonoma to miss earnings and drop 6-7%. That's kind of my hope. And then I'd like to jump in.
It was kind of like, in my mind, it's kind of like what Kevin was talking about earlier. I don't remember the exact term, but when you put all all the different ways that we get in our own way as investors, one of them has something to do with the fear of missing out, kind of not being patient and rushing into positions. And with this company in particular, that's something I've really had to be mindful about, not rushing right in, knowing that there could be some more turbulence from here. So maybe let's slow down, let's wait and see what happens, because there might be an opportunity to buy it at a better price. We'll see.
Absolutely.
What do you think, Kevin?
Well, I think my personal opinion is I like Home Depot better than Dick's. And to be honest, I haven't investigated Dick's Sporting Goods a lot, but just in terms of the products that are offered, I think Home Depot has a stronger foundation, in my opinion. So just from a business perspective, I would lean toward Home Depot.
Yep.
You can't build a home with hockey sticks.
Or cleats.
Or cleats.
Okay. So the next one is that Lucas is in the house. And Lucas, the only thing that I would say is you need to buy a share of Johnson & Johnson so that they'll send you a dividend on your birthday. That is a big deal. So that's from a conversation we had earlier online. So Johnson & Johnson's dividend is on his birthday. And so that's kind of exciting. Okay, here's an interesting, maybe a controversial, but we'll take it anyway, right? We don't pass up questions just because we're afraid of them. Hey, you think good to buy Budweiser beat down with controversy? What do you guys think about Budweiser?
I don't think. I think it's been declining as a brand, but honestly, that famous saying, "This too shall pass." It's gonna pass. It's gonna blow over. I guarantee you. I don't know, a year from now, most people probably won't even remember what's going on with this. But still, I think I had read some blurb somewhere that the Budweiser brand has been declining for years, and that's why they're trying to shake things up. But I would look elsewhere.
Yeah, I've never looked into the company, but I'm kind of with you, Russ. I don't think the current controversy is any reason to stay away from it forever. If you think it's a good company, then like Russ said, this is going to pass. So don't sweat it too much. But other than that, I really haven't looked into the company at all.
Yeah, I can't say anything different. I don't own Budweiser and don't plan to buy it. I haven't looked at it tremendously, but I do think it's a brand that is, it's going to be around for a while. I mean, you got these Clydesdales, right? I mean, it's an iconic brand, but I don't, I just don't. It's not something that works well for my portfolio. So I would say regardless of the controversy, I wouldn't be buying Budweiser. So
Alcohol seems
controversy or not.
alcohol seems extremely fragmented to me. As someone who enjoys his margaritas, I'm not particular about any style. It's I don't know. I don't think there's too much loyalty, and I could be wrong. Too much loyalty when it comes to. Well, I guess there is. For in some sense, there's Bud Light people and there's Coors Light people. So maybe in that sense there is. But overall, I don't know how sticky that type of product is. I could be wrong.
Just invest in Altria. Buy some Altria with that fat
Yeah.
8% plus yield, and Altria does own, I think it's a 10% stake in Anheuser-Busch. If I could be wrong on that, I think it was 10% something. Somebody will correct me. And then you'll get all those dividends. Go buy yourself a Budweiser at the bar with those dividends. There you go.
Okay, Fast Eddie has clarified his question here, and I think I can interpret what's here. It really is out of my last video, which was a video on my portfolio. And at the end of the video, I talk about these approximately 20 stocks that I have that are less than 1% of my portfolio. And so, I'm thinking about doing some house cleaning and how do I, because when I bought those stocks, I liked them and I still like them, right? So it's not that I don't like them all, but having investing the time that I do and listening to earnings calls, reading 10Ks with a stock that is less than 1% of my portfolio gets to be a lot of time. And I just don't know how much value there is. So I either need to increase that or decrease that. So he's wanting me to ask you guys about, how should I go about that process of house cleaning and getting those small stocks out of my portfolio? Or should I just leave them and not worry about it?
I go back and forth on this so much because there's times I think about doing similar things. But if you're going to consolidate, and there's so many ways to skin the cat, if you're going to consolidate, maybe one good place to start looking is to see if there's any overlap in your portfolio. Like let's say, for example, you've got two really similar companies. Maybe you own both Pepsi and Coca-Cola. Do you need both of those? Maybe you own both Home Depot and Lowe's. Maybe try and choose one or the other. I think that'd be a good place to start if you're considering consolidating in your portfolio. But what other ways would you guys go about choosing which stocks to trim?
Well, I've been doing a lot of consolidating. I've probably chopped 8 or 9 stocks since the spring started. And it's easy. I just started with the positions that were either low yielding or I was a little bit down on and maybe had 8, 9 stocks, or 8 or 9 shares, 10 shares, and just consolidated. Like Nexstar, I think they were really undervalued. And I remember selling 10 shares of Comcast to buy more Nexstar media. And I mean, so you could do something like that. But I guess if you can't see yourself building up or adding to that position anytime soon, then maybe you want to consolidate if it's not core, if it's just ancillary, and if you're down, you take a little bit of a tax loss harvest too. So I don't know. It's personal preference, I guess, is, I would look at it.
So I will, I'll keep you guys apprised of what I do here. So, and how I handle it, whether I do nothing or whether I, kind of consolidate some of those smaller positions into bigger positions. Let's see, we're at about 59 minutes here. How are you guys doing with time?
I'm good.
Good.
I brought a pillow, so we could do this all night.
All right, that's great. And we probably will. So let's see. Here's something from Anuj. Anuj is asking, he's buying more of UTG as utilities are taking a crap. UTG beats SPY and after turning on DRIP in the last 20 years. So what do you guys think about utilities and these behemoths that have really nice income, higher yielding companies, but also higher capital?
Well, UTG, I believe, is I think that's the Reeves Utilities closed-end fund, and that's one that I've been looking at. I think it has a yield of over 8%. And I was considering consolidating Duke Energy into UTG. I'm still on the fence, still chewing that one over. It's going to take weeks of me thinking that one through, or if I just start investing into UTG. But I do like the utilities, and I believe what they do is they also sell covered calls. So it's an actively managed fund, and it's closed, meaning that no more new money is going to come in. So like if you have SCHD and new money comes in, then they buy more of those weightings. Like they distribute that $1 or $100 to whatever the weightings are. Because I think, right, I don't SCHD's market cap weighted, is it? Either way, so when you're buying UTG, it's just trading between investors. And if somebody wants to pay a little more for it, then that's how the price fluctuates. It's just like buying auction style. I guess everything's auction style, right? But no more new money's coming in, and it's actively managed, meaning that they're using their time and expertise to pick the positions, sell covered calls on those. And that's why it'll have a little bit higher expense ratio, which I think it might be 0.6, 0.8, something like that, which seems a little bit high. But if you're getting almost 9% yield, that's coming off of the yield. So you're still going to get, I think, over right around an 8% yield on something like UTG. But again, I think, utilities will recover. It's just cyclical. It's just one of the things they go through.
Yeah, you're exactly right, Russ. I looked it up, and that is that Reeves Utility Income Fund. It is a closed-end fund. It has dividend yield of 8.27%. I can actually show this, can't I? Let me try that. Let me try sharing my screen. Share, and
you did it.
Boom. How about that, huh? Let me take this off.
Yeah, here we go.
Awesome. So you can see here that it's the Reeves Utility Income Fund. It has dividend growth, at least in June of 21, as a 0%. So, for me, I mean, you can see here the 5-year CAGR on it is about 3%. I tend to want some growth also when and 3% is good. I mean, it's better than IBM, right? I mean, IBM's got about 2% dividend growth. So
exactly, but you're buying it, from what I understand, for the income. Then it's not you're not buying it. It gives a little bit of capital appreciation, but you're buying closed-end funds for the income. And as Anuj showed it, he said the high yielding closed-end fund beat the index for the sector. So it's just one more thing to consider. I'm kind of new to the closed-end fund game. I'm just learning and digesting all of this, and it's just one more vehicle to consider for some higher income.
Okay, well done. So one question here, and I think it's a good one, is what about Disney with the whole Florida DeSantis stuff going on again? We're not afraid to talk about this kind of stuff, right? What do you guys think about Disney?
Well, I don't know. I know there's some backlash. I think a lot of this could be, so what are they doing, right? I think they're moving positions or people from California over to Florida, and now they're going to nix that. But I think that it's Bob. I'm going to get this confused. Which one? So Iger, right?
Yep.
Iger instituted Chapek, and then Iger didn't like what Chapek was doing, and Iger came back and ousted Chapek. So I think that this is kind of a way for Iger to use the cover of the whole DeSantis thing to kind of undo some of what he didn't like what Chapek is doing. Just my theory on that. I could be wrong, but again, I think it's a little, tete that's going to sound like a broken record. This too shall pass, which I think it will, but I think both sides are digging in, and I don't know, if you're a long-term believer in Disney, I think they're going to be fine. And Yeah, I don't know. I haven't dug into it too much, so that's pretty much the extent of my knowledge on that.
Yeah, I'm kind of the same way. I really haven't looked at it too much. Um, I thought I used to think Disney was a pretty solid investment, but then they cut the dividend, and then I was like, I just don't really care anymore.
That's kind of where I am, Ryan. When they eliminated the dividend, it was like, and then they didn't bring it back, right? When things got better, then I was like, okay, I'm moving on. So,
Yeah,
not a big fan.
I heard they're bringing it back in the fall. I don't know. I could have just imagined that, like I did the the spinoff price or the spinoff amount from Kenview, but I did hear that they're bringing it back. So we'll see how much and how frequent.
I think I heard
Because they
that
used to be
too.
semi-annual, right? They used to only be twice a year on that
Well, I'm
dividend.
not sure. I've never
I
owned
think,
them actually.
yeah, I think they were a semi-annual dividend.
Okay, moving back to our utility discussion. Belkis says that Consolidated Edison is doing pretty good, and he is correct on that. So I used to own Consolidated Edison, and then I sold them and I don't even remember why. That's pretty sad, but I don't remember why. But I moved on to some other things. But they're a solid utility. So
Do you have many utilities in your portfolio, Kevin?
I have I have at least two that I can think of off the top of my head. I have WEC. No, I have three. I have Pinnacle West Capital Corporation, which is a utility out of Arizona, and I really like them. And the reason that I like them is not because they're a utility, but because I believe their commission in Arizona is heavily weighted against them, and that's not going to stay that way forever. So I believe that not only am I getting a high dividend yield now, my yield on cost somewhere around 5% for them, but I'm also going to get some share price appreciation when the politics change in Arizona and that commission begins to give them more favorable rulings. So that's what I'm waiting for Pinnacle West. My other one is WEC out of Wisconsin Electric Corporation. And then my third one is Atmos Energy, which is a gas utility out of Texas. Those are my three.
What are you looking at when you're looking at these utilities? Because you kind of have to look at them a little bit differently than you would a normal company, right?
Mm-hmm. Yeah, so I look for again, dividend growth. I want to have some dividend growth there. I want to see that they are investing in the future. I don't want them to be investing in old technology. I want them to be investing in the future, whether it's smart meters or some of the environmental things like solar and those kind of things. So I'm wanting them to have that futuristic look, but you can't look at cash flow with a utility. It's very similar to a business development company, right? Because they are heavily capital intensive. So the only way they make money is to spend money. So their free cash flow is typically going to be negative. And that's really what you want to see in a utility, because that means they're investing that for the future. So you have to look at them a little differently. Yeah.
So with that said, is the dividend usually financed then, or does it come from net income, or what are they using to pay the dividend?
It'll come from either equity or debt. Yeah.
Okay.
Exactly. But you can compare that to their earnings. So instead of looking at cash flow, you would look at their earnings and see how that plays out against the dividend. So the coverage ratio, the earnings coverage ratio for utilities is the thing to look for, not the free cash coverage ratio, if that makes sense.
Yeah, that's good to know.
Okay. Couple more, and then I think we will call it a day. We're at 1 hour and 8 minutes now, so I think we're going to do a couple more here. One is thoughts, and I think Russ brought this up on his show. Thoughts on Newell Brands. I think they are the makers of Rubbermaid, right? So what do you think about Newell Brands? Maybe we start with Russ, because he's probably looked at it more recently than we have.
I just looked at the headline, the 70% dividend cut, and I'm going to assume they have a lot of debt. I honestly don't know the reason why they cut it. Yeah, I just know they cut the dividends 70%, which was quite a bit. So I would really need to know what's going on there. And if I were to invest in Newell Brands, man, there's issues going on there. So I would need to know and understand fully what the heck is going on and why they had to cut the dividend by 70%.
It doesn't look like the free cash flow situation is too great for them. It was in the red in the last year, and a few years prior to that, it looked like it was red for a couple of those years too.
Yeah, I've pulled it up here, Ryan, on the
Yep.
screen.
There you go.
So yeah, look at 22, negative 65, and negative 95 in the last 12 months. So yeah, it's not looking so good. Yeah, I tend to stay away from companies like that are in trouble, basically. Okay, look at all of this technology going on, man.
It's kind of hard to do multiple things at once.
It really is. Okay, from my long experience investing, do you think the banking collapse is over, or will it continue? And I'd like to get all of us in on this because it is an important discussion. But my personal take on that is I don't. There may be some other peripheral failures around the edges, but the big banks are going to be pretty solid in my opinion. So I think it's really kind of noise from my perspective. I look at SVB and I look at the management team decisions that were made there, and they were horrific. I made the comment one time that I would love to have been in the boardroom when the decision for investing in long-term fixed rate income securities in an environment where interest rates were probably going to move higher, right? So you're fixing your future revenues, but you're increasing your future costs. There's a risk of your future costs increasing. And for somebody to present that in the boardroom and the board go, oh, that's a fantastic idea, right? I don't understand how that can happen in a boardroom. So when I heard what went on there, it was just something that I just felt, and this is my opinion, that they dropped the ball. And so I think for SVB, it was their own fault for what happened. Now, First Republic may be a little different, but I see it kind of as a speed bump, but I don't see it as being catastrophic. What do you guys think?
Go ahead, Russ.
Oh, yeah. Well, I think for SVB, right, as I've heard it distilled down to one sentence, is that they put their money into something that would do bad if interest rates went up, and interest rates went up. So, and it just shook their depositor confidence. And I know all those depositors at SVB were mostly, tech, Silicon Valley, and they all talk to each other. And it really was kind of interesting to watch how a bank run can happen in just a matter of, I don't know, hours. I want to say days, but it may have been out. It's really, really quickly now. You don't have to have people standing in line and the bank trying to get people out of line, right? What was that joke that they say back in the day? If you wanted a bank to fail, you just go stand in line outside and people think, what the hell's going on? And I better get my money.
There used to be people who would stand in line. They maybe not even had money in the bank. They would just stand in line and then sell their spot to other people who wanted their spot in line. They made like a little business doing that.
Yeah, I love that. But I haven't really looked too deeply at it, but I think what we're going to see is this is going to be banking consolidation. I think we're just going to see the bigger banks get stronger. People have that faith in JP Morgan, like they're too big to fail. I just think the bigger banks are going to be fine. And, it's kind of why I've been investing in TD and Toronto Dominion Bank. That's the only bank I invest in. And from what I can tell, they kind of have stayed away from a lot of the riskier things that could really hurt them and reducing their exposure. So I don't know. I would be nervous if I know our buddy Darth, he's been going hard into Key Corp. And I took a few looks. I'm like, buddy, I see a few red flags. So he's like, no, they're fine. I'm like, okay. But I hope so. I hope to God they are. But I would be nervous if I was investing in a regionals and really trying to get a firm grasp on what's going on and what they're invested in and what could potentially hurt and tank them. So, but the JP Morgans, those will be fine. I don't think there's going to be anything wrong with them.
Yeah. I was kind of talking to my dad about this a while back when all this stuff kind of first started. And I think at that point I'd been maybe looking into a couple regional banks. I don't know, nothing serious, but I was just talking to him about it. And he told me you better be careful with the regional banks. If you're going to look at a regional bank, it's probably best to look and invest in one that's actually in your area that you're familiar with. Understand the area and of the people that they service, if that makes sense, and where their customers are at. And so that kind of since he said that thought has kind of stuck with me, and it's kind of turned me off of the idea of investing in regional banks. The ones I was looking at were like maybe in the Midwest or on the East Coast, and I had to be real with myself. I don't know anything about what's going on over there, so that probably wouldn't be the most fitting investment for me. But it does seem like the bigger banks, like the Bank of America's and JP Morgan's, play. They're maybe under a more watchful eye, and so maybe they play with a different set of rules, making them a bit more secure than the regionals. Would you guys say?
I think so.
Yeah, I would agree with that. So, guys, I really appreciate you guys joining. Don't forget to give the live stream a thumbs up. I'm having way too much fun with this technology here. So, yeah, to give that a thumbs up. And I appreciate you guys staying over because, man, this conversation was really riveting. And I think it's been really fun to have you guys on and just to kind of kick it around a bit because it's just a lot of fun to talk about dividend stocks. And of course, you know, our viewers here have made it a lot of fun as well with your questions and your engagement. So we appreciate all of that. So
I want to say before we go, I've been reading in the comments between Anuj and Zell, and I got a lot to look into about the closed-end funds. They got a nice little back and forth going about the expense ratios and CEF. So yeah, like I said, I'm literally just beginning my knowledge journey into the world of closed-end funds. So I've got weeks of research to do. And I really do love that. Like, that is what I love. It's just, I've been kind of a fly on the wall watching them go back and forth. I've really enjoyed that.
Russ, let's start a book club. We could read The Income Factory first.
I'm going to have to I might get that and read that on the plane. I'm finishing. I got probably another half hour left in Richer, Wiser, Happier, which I may just have to buy this because I'm going to read it again. But this has been a wonderful read. If anyone's looking for an easy read, definitely recommend Richer, Wiser, Happier by William Green.
Last thing. Sorry, I know you're trying to sign off, Kevin, but Russ, I'm going to send you a link to the Discord after we get off so you can officially join.
I will. I think I'm going to spend more time there than on Twitter because I just really haven't been getting much from Twitter these days.
Yeah, and I'll add the link also in this video. So if you're watching this and the after it's already closed out, then you can go to the notes and click on it from there.
But last thing I wanted to say was, Kevin, thank you so much for including me in your first live stream. It's always a lot of fun being able to chop it up with you guys and talk with you guys. So I'm down to do this anytime you want. And also all of you guys watching in the audience, thank you for tuning in with us this last hour and 20 minutes or so. It's always fun being able to chat and hang out with you guys and talk stocks.
Yeah. So, the only way I could to respond to that is that, guys, you always remember your first. So thanks for being a part of that.
For better or worse, we remember our first.
That's right. All right. Well, I appreciate you guys being on, and we're going to sign off now. So have a great evening, everybody.
See you, everyone.